Section 1.1 to 1.2 Understanding the Efficient Frontier. 1.1 Introduction to the Efficient Frontier. The efficient frontier is a concept in portfolio management that represents a set of optimal portfolios that offer the maximum expected return for a given level of risk, or the minimum level of risk for a given expected return. It is a graphical representation of the various combinations of assets that form efficient portfolios. In portfolio management, investors aim to achieve the highest possible return for a given level of risk or the lowest possible risk for a given level of return. The efficient frontier helps in identifying the optimal portfolio allocation that balances risk and return. The significance of the efficient frontier in portfolio management can be understood through the following key points: risk and return trade-off. The efficient frontier demonstrates the trade-off between risk and return. It illustrates that investors can achieve higher returns by accepting higher levels of risk, or they can reduce risk by accepting lower returns. The efficient frontier allows investors to identify the portfolio that best suits their risk tolerance and return objectives. Diversification benefits. The efficient frontier emphasizes the importance of diversification in portfolio management. It shows that by combining assets with different risk and return characteristics, investors can construct portfolios that offer higher expected returns for a given level of risk, or lower risk for a given level of return. Diversification helps to reduce the overall risk of the portfolio without sacrificing potential returns. Portfolio optimization. The efficient frontier serves as a tool for portfolio optimization. By plotting various asset combinations on the efficient frontier, investors can determine the optimal mix of assets that maximizes returns or minimizes risk based on their preferences. Portfolio optimization involves finding the portfolio that lies on the efficient frontier and aligns with the investor's risk and return objectives. Comparison of investment options. The efficient frontier allows for a comparison of different investment options. By plotting different assets or portfolios on the efficient frontier, investors can visually assess the relative attractiveness of different investment opportunities. They can evaluate whether an investment provides sufficient returns for its associated level of risk or if it can be improved by adjusting the portfolio composition. Overall, the efficient frontier provides a framework for investors to make informed decisions about portfolio allocation by considering the trade-off between risk and return. It helps investors optimize their portfolios to achieve the desired level of return while managing risk effectively. The efficient frontier is directly related to the risk and return trade-off in portfolio management. It illustrates the different combinations of assets that offer the maximum expected return for a given level of risk or the minimum level of risk for a given expected return. Here's how the efficient frontier relates to the risk and return trade-off. Risk. The efficient frontier represents portfolios that cover a range of risk levels. On the efficient frontier, portfolios towards the left side are less risky, while portfolios towards the right side are riskier. As you move along the efficient frontier from left to right, the expected return increases, but so does the level of risk. This indicates that to achieve higher returns, investors must be willing to accept a higher level of risk. Return. The efficient frontier also illustrates the expected returns of different portfolios. Portfolios located higher on the efficient frontier offer higher expected returns, while portfolios located lower on the frontier offer lower expected returns. Investors seeking higher returns will need to select portfolios that lie towards the upper portion of the efficient frontier. However, these portfolios will typically have higher levels of risk. Optimal portfolio. The efficient frontier helps investors find the optimal portfolio that balances risk and return according to their preferences. Each investor has their own risk tolerance and return objectives. By analyzing the efficient frontier, investors can identify the portfolio that maximizes their expected return for a given level of risk, or minimizes risk for a desired level of return. This optimal portfolio lies on the efficient frontier and represents the best trade-off between risk and return for the investor. Diversification. The efficient frontier emphasizes the benefits of diversification in managing the risk and return trade-off. By combining assets with different risk and return characteristics, investors can construct portfolios that offer higher expected returns for a given level of risk, or lower risk for a given level of return. Diversification helps to reduce the overall risk of the portfolio without sacrificing potential returns. The efficient frontier highlights the importance of selecting assets that have a low correlation with each other to achieve effective diversification. In summary, the efficient frontier showcases the relationship between risk and return in portfolio management. It demonstrates that investors can achieve higher returns by accepting higher levels of risk, and vice versa. The efficient frontier assists in identifying the optimal portfolio allocation that strikes the right balance between risk and return, while also highlighting the significance of diversification in managing the risk and return trade-off. 1.2 Theoretical Foundations of the Efficient Frontier, explaining the principles of modern portfolio theory, MPT. Modern portfolio theory, MPT, developed by Harry Markowitz in the 1950s, is a framework for constructing and managing investment portfolios. MPT is based on several key principles. Diversification. MPT emphasizes the importance of diversification in portfolio construction. According to MPT, by combining assets with different risk and return characteristics, investors can reduce the overall risk of their portfolios without sacrificing potential returns. Diversification works because different assets tend to have imperfect correlations with each other, meaning they may perform differently under different market conditions. By diversifying across assets, investors can potentially mitigate the impact of negative events on their portfolio. Efficient frontier. The efficient frontier is a central concept in MPT. It represents a set of optimal portfolios that offer the maximum expected return for a given level of risk or the minimum level of risk for a given expected return. The efficient frontier graphically illustrates the risk and return trade-off and helps investors identify the portfolio that best aligns with their risk tolerance and return objectives. Risk and return. MPT recognizes that investors are concerned with both risk and return. MPT defines risk as the volatility or variability of returns. It measures risk using statistical tools such as standard deviation. MPT assumes that investors are risk-averse and seek to maximize their expected return for a given level of risk or minimize risk for a desired level of return. By analyzing the risk and return characteristics of different assets, MPT provides a framework for selecting assets and constructing portfolios that optimize the risk and return trade-off. Asset allocation. MPT emphasizes the importance of asset allocation in portfolio management. Asset allocation refers to the process of allocating investments across different asset classes, such as stocks, bonds, and cash. MPT suggests that the majority of a portfolio's return is determined by its asset allocation rather than the selection of individual securities. MPT encourages investors to focus on determining the optimal mix of assets that aligns with their risk tolerance and return objectives. Efficient market hypothesis. MPT is based on the efficient market hypothesis, EMH, which assumes that financial markets are efficient and reflect all available information. EMH suggests that it is difficult to consistently outperform the market through individual security selection or market timing. Therefore, MPT advocates for a passive investment approach, such as investing in broad market index funds, as a way to capture the overall market return. Risk-return optimization. MPT employs mathematical techniques to optimize the risk and return characteristics of a portfolio. It involves calculating expected returns, standard deviations, correlations, and other statistical measures to determine the optimal portfolio allocation that lies on the efficient frontier. The goal is to find the portfolio that provides the highest expected return for a given level of risk or the lowest risk for a desired level of return. By incorporating these principles, modern portfolio theory provides a systematic approach to portfolio construction and management, aiming to maximize returns while minimizing risk through diversification and efficient asset allocation. Understanding the concepts of risk, return, and diversification, let's explore the concepts of risk, return, and diversification in the context of investments. Risk. In investment terms, risk refers to the uncertainty or potential variability of returns. It represents the possibility of losing some or all of the invested capital. Different investments carry varying levels of risk. Generally, higher risk investments have the potential for higher returns but also a greater chance of loss. Risk can arise from factors such as market volatility, economic conditions, company-specific events, and regulatory changes. It is typically measured using statistical indicators such as standard deviation, beta, or volatility. Return. return is the gain or loss on an investment expressed as a percentage of the initial investment amount. It represents the financial outcome or profitability of an investment. Investors seek returns as compensation for taking on risk. The potential returns from an investment depend on various factors such as the asset class, investment strategy, market conditions, and specific investment choices. Returns can be categorized into different types, including capital gains, from price appreciation, dividends or interest income, and other investment income. Investors aim to maximize their returns while managing risk effectively. Diversification. Diversification is an investment strategy that involves spreading investments across different assets, sectors, industries, or geographic regions. The goal of diversification is to reduce risk by avoiding overexposure to any single investment or asset class. By diversifying, investors can potentially minimize the impact of negative events affecting a particular investment or sector. Diversification works on the principle that different assets tend to have imperfect correlations, meaning they may perform differently under different market conditions. Therefore, when one investment may be experiencing a decline, another investment in the portfolio may be performing better, helping to offset losses. Diversification can be achieved through various means, such as investing in a mix of stocks, bonds, real estate, commodities, or other asset classes. Additionally, diversification can be applied within each asset class, by selecting different companies or securities. The specific level of diversification depends on an individual investor's risk tolerance, investment goals, and time horizon. By understanding risk, return, and diversification, investors can make informed decisions about their investment portfolios. Balancing the desire for higher returns with an appropriate level of risk and implementing diversification strategies can help investors optimize their investment outcomes while managing exposure to potential losses.